on ET Now continues. We have Sachin Tikekar, who is the Joint Managing Director at KPIT Tech, joining us. Welcome, Mr. Tikekar. Let me first start off by understanding from you. There are plenty of headwinds in the global marketplace, and you are a fast-growing company. What are the levers you're using, and how comfortable are you with the guidance you've provided in terms of growth?
Thank you for having me, and good morning to all of you. Yeah, it's interesting times to say the least, and obviously we are a high-growth company, and this is not. We feel very uncomfortable being in the situation that we've been over the last year, but that's life. However, we do see some things that are improving. Number one, most of the tariffs across the globe are settling down to some extent for now. The disruption to the supply chain is also settling down. So most of our business, as you know, comes from passenger car, trucks, and off-highway. So the OEMs, even though their profits have gone down by almost 50% year on year, what they've done is they've reprioritized their investments now. And we think that some of the programs, we are obviously seeing demand being generated in some areas than the others. So for example, the deprioritization of programs happened in next generation architecture and so forth. And where we are seeing demand is e-cockpit, after sales, diagnostics, and cost reduction ideas are always in fashion these days. So given all of this, now that things are settling down a little bit, the drop in the programs is going down, and we continue to build solid pipeline and have fairly sound closures. That gives us confidence that H2 is certainly going to be better than H1, and we are looking forward to the next financial year, which we hope is better than the current financial year.
Okay, so that sounds good. Mr. Tikekar, talk to us about your profitability. And we understand this quarter it was impacted by a slight one-off. But as things normalize, what would be a realistic expectation on the profitability and the EBITDA front? You've guided for a 21% growth. What would be the timeline for that?
So first of all, I'm glad that we've been hold on to our EBITDA throughout the year. In fact, it's actually increased a little bit in spite of all the challenges that the industry is facing. We believe, and one of the reasons why that has happened is some of our business has actually gone down because our clients deprioritize some of the programs. But we have also cannibalized our own business by providing solutions in place of services, which is a huge transformation that we are going through. And what I mean by service solutions is basically it has higher reusability in terms of platform tools and accelerators, and also application of AI. So what we are doing is we are cannibalizing our existing business in hope that we'll be able to create greater value for our clients in the long run, and we'll be able to do more with less. So in spite of not having growth in H1, we've been able to hold on to margins because the quality of business has gone up. And we believe that this transition from services to mostly solutions will continue for the next 4 to 6 quarters. So we believe that in spite of making heavy investments in future, we'll be able to hold on to our margins. That's what we think. That's our outlook for H2. And that's also our hope as we get into the next financial year.
Mr. Tikekar, what does that do to Topline? Because it's very fascinating that you say this, that you're actually trying to, or rather you're cannibalizing your own business. What does that do to your top line? Because that will mean that despite you holding on to margins, if top line growth doesn't come, your EBITDA as a consequence will largely remain on this 300 crore kind of run rate quarterly.
Let me clarify. So this is a trap. So like I said, there were 2 reasons why the business went down. 60% because of the programs got deprioritized, 40% because we cannibalized our own business. And now that OEMs are not cutting programs because they've cut enough, we believe that the drop of business will go down. And as you can see, in in H1 of this year, the drop was to the tune of $65 million. And that means we have also added business worth $60 to $65 million. So when I say H2 is going to look better than H1, it also means in terms of the top line. And we do hope that the growth in top line and also bottom line comes back, and it's much better than what it is in the current year.
Okay, and Mr. Tikekar, help us understand the geographical mix of your growth this time around. On a sequential basis, we've seen positive growth from Europe, while we've seen degrowth from US and Asia. What is your outlook, and what could the mix look like going ahead?
Oh, absolutely. If you look at US OEMs are far more aggressive than any glitch in the economy. The cost cutting happens first. So the most of the deprioritization of programs that has happened with the OEMs in the US to a larger extent, followed by some OEMs in Asia and some in Europe, and we believe that that's stabilizing now. Also, the solutions that I talked about earlier on, backed by our platform tools, accelerators, and artificial intelligence, we have also cannibalized our business to a larger extent in the US as compared to the other two geographies. It means that we should see fairly balanced growth across the three geographies. Let me add a little bit of color. Europe will continue to grow. We have seen growth in Europe, and we believe it will continue to grow. In the US, I think we should start to see turnaround as we get towards the end of this year and early next year. In Asia, we are very bullish about our investments that we've made for India to India solutions and China for China solutions. So we believe that Asia will also be one of our growth drivers as we get into the second half as well as the next year.
Okay, and with regard to you've suggested as the earlier part of this conversation that the EV manufacturing programs have been pushed, right, by maybe a year or two.
Yes.
And H2 is likely to be stronger for you than H1, and materially stronger is what you've hinted both on your con call as well as what you're hinting now. Give us a sense of what will drive that growth then, because EV was a major part of what that growth or where that growth was going to come from. So what is it that's going to drive growth?
So let me just clarify. Propulsion that includes electrical vehicles, it's only 30% of our business, and electrification is 50% of that. So overall business, it's about 15 to 18%. And obviously that has gone down to some extent. However, we see a lot of growth coming from e-cockpit. That's where OEMs have made investments, and now it's time for them to continue to enhance and get more value out of that. So e-cockpit will be a big area of growth. Second area of growth, we believe, is going to be what is being called now navigation on autopilot. Navigation on autopilot has become a standard in China. It will also become a standard in Europe, in some of the European countries, in the US. So we believe navigation on pilot will be another. Third is, and this goes to our acquisition of N-Dream. This is also about creating features and experiences for the consumers and the drivers within the vehicles as navigation on autopilot becomes more prominent. So consumer experience will become really important. And these are the three areas where we will see more growth coming. Last but not the least, this goes back to the acquisition of the business from Caresoft. It is about vehicle engineering and cost reduction, and that's always in fashion. So we think that we'll see growth coming from that end as well in terms of our offerings.
So what's the journey looking like over maybe the next 2 years to 3 years? The 20% top line growth, are you confident? Are you comfortable of clocking that? And of course, you're suggesting that margins will hold. As your base goes up, I see you smiling, but as your base goes up, how difficult does that get?
No, You've seen the only reason we are a little bit skeptical is what we have experienced in the last year. I think there are just too many uncertainties to look beyond the next 2 quarters at this point in time. Overall, the feeling is better. However, we are still not out of it completely. What we believe is we'll be in a much better position to talk about the next year as we get towards the end of this calendar year. So by when we speak again in end of December, early January, I think we'll have a better view for the next financial year. But your question was also about a little bit midterm. If you take a 2 to 3 year view, we believe that KPIT is in a pole position to remain in the lead as we continue to make investments in future. Hopefully we'll be able to create that pull factor for the OEMs. And we remain really bullish for the midterm. And another reason for that is it's not just going to be passenger cars for us. I think our investments in trucks and off-highway, they've started to pay off now. And another area which is really growing is the mobility part of defense. That's something that we are evaluating very closely. So we remain fairly bullish as far as the midterm outlook is concerned.
Right. Thank you so much, Sachin. You've come in, you've answered those questions very candidly. Thank you so much. We appreciate you coming in and speaking with us.
Thank you very much. Always a pleasure.